All right, so today we're gonna dive into this age-old question. Can you really beat Wall Street? We've got a fascinating source for you today. It's a YouTube video
Okay.
that unpacks Burton Malkiel's classic book, A Random Walk Down Wall Street.
Right.
I'm excited to see what we uncover together.
Yeah. This book is still making waves. Even though it was first published back in the 70s, it really digs into like the core of market behavior. And
Yeah.
whether all that fancy analysis everyone talks about
Yeah.
actually gives anyone a real advantage.
Okay, I'm intrigued already. So the video jumps right in with this. Monkey with a dartboard theory.
Right.
So is it saying that a monkey throwing darts at stock listings could actually do as well as professional investors?
That's the provocative question Malkiel starts with. It gets us thinking about whether markets are maybe more random and less predictable than we tend to believe. The idea that with enough smarts and data, we can consistently outsmart the system might be more of a fantasy than reality.
Okay, so that sets the stage. Then the video goes on to debunk the two main approaches to investing, starting with fundamental analysis. So for our listener, this is where you're poring over a company financials, earnings reports, looking at potential growth. Sounds pretty solid on the surface.
It's the classic approach, right? The idea is that if you could perfectly predict a company's future, fundamental analysis would be foolproof. But even the sharpest analysts have a tough time with that.
Well, yeah, think about it. There are so many curveballs life can throw at a business, Unexpected events, shifts in consumer behavior. I mean, we've all seen how fast things can change.
Exactly. The video uses some really vivid examples, like natural disasters, like taking out factories, or the sudden loss of a CEO. Those kinds of things are almost impossible to foresee, even with the best research.
Yeah, and let's not forget about companies playing fast and loose with their accounting.
Oh, yeah.
Even if you're a spreadsheet wizard, bad data leads to bad analysis.
Absolutely. Incomplete or misleading information from the companies themselves throws a wrench into the whole process.
Okay. So fundamental analysis has its weak points. But what about technical analysis? That's all about charts and patterns, trying to predict price movements based on past data, almost like reading tea leaves, but for the stock market.
Right. Malkiel calls this the castles in the air theory. The video points out how stock prices are often driven more by crowd psychology, the collective hopes and fears of investors, than by a company's actual value. It's about identifying trends. And those trends can lead to massive bubbles.
Okay, this is where things get interesting. The video brings up some wild examples from history, like tulip mania back in the 1600s. People were gambling their fortunes on tulips.
Yeah.
It sounds crazy.
It sounds wild now.
Yeah.
It shows how. Even level-headed people can get caught up in that speculative frenzy. Prices get driven way beyond what's reasonable, and it's all fueled by trends and sentiment.
Right.
That's the danger of relying solely on technical analysis. It might work for a while, but when the bubble inevitably bursts, you can imagine what happens.
Ouch.
So if both of these common approaches, fundamental and technical analysis, have their flaws, what's the alternative? Is Malkiel saying there's no way to make informed investment decisions?
That's where his core argument comes in. It's pretty radical. He suggests that markets are essentially random walks, unpredictable in the short term. He looks at the performance of long-term index fund investors, who often do better than those trying to actively pick stocks or time the market.
Hold on. This is making me rethink everything I thought I knew about investing. So trying to beat the market is the wrong goal entirely.
It certainly raises some big questions if even the pros have a hard time consistently outperforming the market. What are the chances for the average investor?
All right, let's go deeper. The video then dives into the psychology of investing and how our own brains can trip us up. It seems like this is where things get really fascinating. Absolutely. The video highlights 4 main biases that can affect all of us: overconfidence, distorted judgments, herd mentality, and loss aversion. These biases can really mess with our decision-making, even when we think we're being perfectly logical.
Okay, let's break those down. Starting with overconfidence. I've definitely been guilty of this. It's that feeling that we're smarter or luckier than we are, which can lead to some risky moves.
Yeah. You hit the nail on the head. We overestimate our ability to pick winners.
Oh.
Or perfectly time our buys and sells. This can lead to taking on more risk than we can really handle. Or making rash decisions based on gut feelings rather than solid research.
Right. And then there's distorted judgments. The video talks about seeing patterns where there are none. Especially in a market that's essentially random, it's kind of like seeing shapes in the clouds. but with stock prices instead.
That's a great way to put it. Our brains are wired to look for patterns, and sometimes we find them, even when they don't really exist. We convince ourselves that a stock is about to take off, based on flimsy evidence or just a hunch.
Yeah.
That kind of thinking can be dangerous.
Okay, herd mentality is a classic. We follow the crowd, even when it's headed for a cliff. Haven't we all been tempted by a hot stock tip just because everyone else seems to be making a killing?
Oh, it's incredibly powerful, especially in the age of social media. You see everyone bragging about their gains, and that fear of missing out takes over.
Right. And lastly, we have loss aversion. The video describes it as feeling the pain of losing money much more intensely than the joy of winning.
It's a real phenomenon, and it can lead to some bad choices. We might cling to losing investments for too long, hoping they'll bounce back. Even when all signs point to selling, we're so afraid of taking a loss that we end up making things even worse.
Wow, this is making me wonder if I should just bury my savings in the backyard. But the video does offer some advice from Malkiel Wright, some actual steps we can take to be smarter investors.
Yes, and this is where I think things get really valuable for our listener. Malkiel lays out 5 key tips for a more rational, long-term approach to investing.
All right, I'm ready. What wisdom does Malkiel have for us?
Okay, first he emphasizes that risk and return are always linked. Higher potential returns typically come with higher risk, and vice versa. You need to be honest with yourself about how much volatility you can handle, both financially and emotionally. Don't get swept up in chasing returns if you can't handle the potential downsides.
Right, no pain, no gain, but know your limits. Makes sense. What else?
He's a big believer in the power of time. The longer you stay invested, the more likely you are to ride out those inevitable market ups and downs and come out ahead in the end.
So patience is key. This isn't some get-rich-quick scheme. It's about playing the long game.
Exactly. It's a more sustainable and, honestly, a lot less stressful way to approach investing. He also talks about dollar cost averaging. This means investing a fixed amount at regular intervals, regardless of what the market is doing.
Okay, that sounds like a smart strategy, especially for those of us who aren't experts. At timing the market, what are the other tips?
Knowing your risk tolerance is crucial. This is about being honest about how much risk you can handle financially, and just as importantly, emotionally. It's different for everyone, and it can change over time, depending on your circumstances.
So really taking a personal inventory of your risk comfort level, that makes a lot of sense. And what's the final piece of advice?
Malkiel's a big advocate for rebalancing your portfolio regularly. This means making sure that your investments still align with your goals and your risk tolerance over time. As some investments perform better than others, your asset allocation can shift, and that might expose you to more risk than you intended. Rebalancing keeps everything on track.
Okay, this is a lot to digest. The big takeaway seems to be that trying to outsmart the market might be setting yourself up for disappointment.
Well, it certainly encourages
Yeah.
a different way of thinking. The real lesson here might be that understanding the inherent randomness of the market can actually help us make
Well,
more intelligent, informed decisions.
instead of trying to beat the system, we learn how to participate in it in a way that aligns with our own individual goals and risk tolerance.
That's a great way to put it.
It's like choosing our own adventure rather than playing someone else's game.
Yeah, we're taking back control. But that doesn't mean we're ignoring the realities of the market. It's about focusing on what we can control. Things like our savings rate, how our assets are allocated, and keeping our investment costs low. We let the market do its thing while making smart choices along the way.
This is really eye-opening. We've looked at the shortcomings of traditional approaches, explored how our psychology affects our choices, and now we have some practical advice to apply. But we started with this concept of a random walk. What does that really mean for us as investors?
If we connect this back to the bigger picture, the random walk theory tells us that short-term market swings are essentially unpredictable. They're like the steps of someone wandering around aimlessly. You can't really say where they'll go next.
So does that mean all those fancy algorithms and trading strategies people brag about are just smoke and mirrors?
Not necessarily. They might work for some people for a short time. But the evidence suggests that over the long run, they don't consistently outperform the market. It's like trying to predict a coin toss. You might get lucky a few times in a row, but over many tosses, it'll average out.
That's a great analogy. So Malkiel is advocating for a more passive, long-term approach. We accept that we can't control those short-term fluctuations, but we can choose how we respond to them.
Right.
That makes sense. So what does all of this mean for our listener? What's the key insight they should take away from this deep dive so far?
I think the biggest takeaway is that understanding this idea of a random walk can be incredibly freeing. It takes the pressure off. Trying to time the market perfectly or pick the next hot stock. It's about shifting our mindset from trying to beat the market to understanding how to participate in it in a way that aligns with our own goals and risk tolerance.
It's like letting go of that illusion of control and embracing a more evidence-based approach to investing. Less about chasing the latest trends, more about making solid, well-informed decisions.
Exactly. It's about focusing on what we can control. That's where Malkiel's advice. About long-term, diversified investing. And things like dollar cost averaging become so valuable. It might not be flashy, but it can be extremely effective over time.
It sounds like the best way to beat Wall Street is to not play their game at all. We focus on building a solid, diversified portfolio, manage our risk, and let time work its magic.
You got it. It might not be as exciting as day trading or chasing the latest stock tips, but it's a much more sustainable path to financial well-being.
And probably a lot less stressful, too. I know I'd rather spend my time enjoying life than glued to a stock ticker, constantly worrying about every little blip in the market.
I think a lot of people would agree with you there.
This deep dive has really made me think differently about my own approach to investing.
Me too.
It's given me a lot to consider. But before we move on, I have a question that's been bugging me. If markets are really just random walks, does that mean investing is all just a game of chance? Are we all just flipping coins and hoping for the best?
That's a great question. And it takes us right to the heart of the debate about market efficiency. If markets are truly random, does that mean there's no skill involved? No way to get an edge?
I'm grappling with that myself. We've seen all this evidence that predicting short-term movements is basically impossible. But there are people who seem to consistently outperform the market, at least for a while. How do we make sense of that?
I think the key is separating luck from skill. In any random system, there will always be outliers. People who get lucky streaks and do better than average. But that doesn't automatically mean they have some secret formula or special talent.
So it could just be a statistical fluke. If you flip a coin enough times, you're bound to get a run of heads, even though the odds are still 50-50.
You got it. And the same logic applies to investing. There will always be some investors who get lucky, pick a series of winning stocks, or time the market perfectly. But that doesn't mean they can repeat that success reliably over time.
Okay, so how do we distinguish between luck and skill? If someone has been outperforming the market for, say, 5 years, is that just a lucky streak, or is there something more to it?
That's where it gets tricky. It's tough to separate the two, especially over shorter periods. But the longer the track record of outperformance, the more likely it is that there's some skill involved. It's about looking for patterns over years, not just a few lucky bets.
So it's about consistency over time, not just a few wins.
Exactly. And even then, there are no guarantees. Even the most skilled investors can go through periods of underperformance or make mistakes.
This makes me think that maybe the true key to success in investing isn't trying to outsmart everyone else. It's about understanding the rules of the game, managing our own behavior, and making smart choices based on sound principles.
That's a great insight. And that's where Malki's advice comes back in. Those tips we discussed. Risk management, diversification, dollar cost averaging. They're not about trying to beat the market. They're about playing the game strategically to maximize our chances of long-term success.
So it's not about eliminating risk altogether. It's about understanding it and managing it intelligently.
That's exactly it. Investing always involves some degree of risk. The key is knowing how much risk you're comfortable with and how to mitigate that risk through things like diversification.
This deep dive has really challenged some of my assumptions about investing. It's making me think that maybe the less glamorous, slow and steady approach is actually the smartest way to go.
I think that's a great takeaway from our conversation. And for our listener who might be feeling overwhelmed by all the information out there, remember this: you don't need to be a financial whiz or a market guru to be a successful investor.
You just need to understand the fundamentals, keep your emotions in check, and stick to a disciplined plan.
Well said. And if you ever find yourself doubting, remember that monkey throwing darts. It's a reminder that sometimes the best approach is to keep it simple and focus on the long game.
So as we wrap up this part of our deep dive into the world of investing, here's something for our listener to ponder. If markets truly are random walks, does that make our investment choices any less meaningful? Or does understanding the randomness actually empower us to make better choices, free from the illusion of control. What do you think?
It's a question worth pondering. If we accept the randomness, does it diminish the importance of our choices, or does it make them even more crucial? It's a question worth pondering. If we accept the randomness, does it diminish the importance of our choices, or does it make them even more crucial?
It's a real head scratcher. But let's shift gears for a moment and dig deeper into some of Malkiel's advice. We talked about dollar cost averaging, but the video doesn't fully unpack why it's so effective.
That's a good point. It's more than just a mechanical process. It actually has a lot to do with our psychology and how we react to market volatility.
Okay, I'm all ears. Explain this to me like I'm a newbie investor.
Well, think about it. When markets are soaring, we're often tempted to jump in and buy, even if prices are inflated. But when markets tank, fear takes over. And we're hesitant to invest, even when bargains are to be had.
Oh, yeah, I've totally been there. Fear and greed, the classic drivers of bad decisions.
Right. But dollar cost averaging takes the emotion out of it. By investing a set amount at regular intervals, you're automatically buying more when prices are low and less when they're high. It's a disciplined approach.
Yeah.
That helps us avoid those knee-jerk reactions that can hurt our returns in the long run.
So it's almost like a built-in safeguard against our own worst impulses. I like that.
Exactly. And there's evidence to suggest it can improve long-term performance compared to trying to time the market perfectly, which, as we've discussed, is incredibly difficult to do consistently.
This is really making me think about my own approach. I'm generally a pretty cautious person, but even I've been tempted to chase those hot stock tips, especially when you see everyone else seemingly making easy money.
You're not alone. It's human nature to want to be part of the action, to ride that wave of excitement. But that's precisely when those psychological biases we discussed earlier can really take hold.
Yeah, you're right. The fear of missing out is a powerful motivator, but it can also lead us down some pretty dangerous paths.
It certainly can. And that's why Malkiel stresses the importance of knowing your own risk tolerance. It's not just about how much money you can afford to lose. It's also about your emotional capacity for handling those inevitable ups and downs.
It's like knowing your limits in any other area of life, right? You wouldn't try to run a marathon without proper training and an understanding of your physical capabilities.
That's a great analogy.
Yeah.
And the same applies to investing. It's about being honest with yourself and choosing a strategy that you can stick with, even when things get rough. If you're constantly stressed out and second-guessing yourself, you're not going to be successful in the long run.
It makes sense. So we've talked about dollar cost averaging, risk tolerance, the importance of time. But what about diversification? The video mentions it as one of Malkiel's key recommendations, but I'm wondering if you could expand on that a bit.
Sure. Diversification is essentially about not putting all your eggs in one basket.
Yeah.
It's about spreading your investments across different asset classes, stocks, bonds, real estate, maybe even alternative investments like commodities or precious metals. This helps to reduce your overall risk.
So if one area of the market is performing poorly, others might be doing well, and that helps to balance things out.
That's the idea. It's about mitigating those inevitable fluctuations, even if you believe in a particular sector or company. Spreading your risk across different areas helps to protect your portfolio from those unexpected downturns.
I see. So even if you're really bullish on, say, technology stocks, you wouldn't put all your money into that one sector.
That's right. Even within a specific sector, it's wise to diversify. Don't just invest in one or two companies. Spread your bets across a range of companies with different sizes, business models, and growth prospects.
That's starting to sound pretty complex. How does the average investor figure out how to properly diversify their portfolio? Are there any rules of thumb or resources you can point our listener to?
There are definitely some guiding principles and a lot of great resources available. One common approach is to allocate your investments based on your time horizon and risk tolerance. For example, if you're young and have a long time horizon, you might be more comfortable with a higher allocation to stocks, which historically have higher growth potential, but also come with more volatility.
And as you get closer to retirement, you might shift more towards bonds or other less risky assets.
Exactly. It's about adjusting your allocation. As your life circumstances and financial goals change, there are also many online tools and calculators that can help you determine a suitable asset allocation based on your individual needs and risk profile.
That's great to know. And I'm sure there are financial advisors who can help with this as well.
Absolutely. If you're feeling overwhelmed or unsure about how to approach diversification, a qualified financial advisor can provide personalized guidance and help you create a portfolio that's aligned with your specific goals, and risk tolerance.
Okay, so we've covered a lot of ground here. We've talked about the randomness of the market, the psychological traps we can fall into, and some practical advice from Malkiel. But there's still one piece of his advice we haven't touched on yet, rebalancing. The video mentions it briefly, but I'm curious to hear your take on why it's so important.
Yeah, rebalancing is often overlooked, but it's a crucial part of maintaining a well-functioning portfolio over time. As certain investments perform better than others, your original asset allocation can drift. This can expose you to more risk than you intended. Rebalancing involves periodically adjusting your portfolio back to your target allocation.
So it's like doing a regular checkup to make sure your investments are still aligned with your goals and risk tolerance.
Precisely. Let's say you started with a portfolio that was 60% stocks and 40% bonds. If the stock market has a great year, your stock allocation might balloon to 70% or even 80%, while your bond allocation shrinks. Rebalancing would involve selling some of your stock holdings and buying more bonds to bring your portfolio back to that original 60-40 split.
That makes sense. So it's not about trying to pick winners or losers. It's about maintaining a consistent level of risk over time.
That's the key takeaway. Rebalancing helps to ensure that your portfolio stays aligned with your long-term investment strategy, regardless of short-term market fluctuations.
It sounds like rebalancing is a kind of counterintuitive move. You might be tempted to just ride the wave when a certain asset class is performing well, but you're actually saying it's smarter to sell high and buy low, even if it feels counterintuitive in the moment.
You're absolutely right. It can feel uncomfortable to sell investments that have been doing well. But remember, rebalancing is about managing risk and sticking to your long-term plan. It's about taking some profits off the table when things are hot and reinvesting them in areas that might be temporarily undervalued.
This is making me realize that successful investing isn't just about picking the right investments. It's about managing your own psychology, making disciplined decisions, and having a long-term perspective.
I couldn't agree more. It's about being a strategist, not a speculator. It's about understanding the inherent risks and rewards and making choices that align with your individual goals and risk tolerance.
So we've covered a lot of Malkiel's advice, but there's still this lingering question about the random walk. If markets are truly unpredictable, does that mean it doesn't matter what we invest in or when? Are we all just at the mercy of chance?
That's a really important question, and one that many people struggle with. If randomness truly reigns, does that diminish the role of skill and strategy?
It's a bit unsettling, honestly. On the one hand, we've seen all this evidence that trying to predict short-term market movements is a fool's errand. But then you see these hedge fund managers and star investors making huge returns year after year. Are they just lucky? Or is there something more to it?
That's the million-dollar question, and it gets to the heart of the ongoing debate about market efficiency. How do we reconcile the idea of randomness with the fact that some people seem to consistently outperform the market?
I'm curious to hear your perspective on this. Do you think it's possible to beat the market consistently, or is it all just a matter of luck and timing?
Well, as we've discussed, there will always be outliers, individuals or funds that achieve exceptional returns, sometimes for extended periods. But the question is, can they sustain that performance over the truly long term? And is it due to genuine skill or simply a lucky streak?
Okay, so how do we separate the truly skilled investors from the lucky ones? Is there any way to tell the difference?
It's a challenging task, and there's no foolproof method. But there are some things to look for. When evaluating track records, for instance, has the outperformance been consistent across different market cycles? Has the investor or fund manager demonstrated a clear and repeatable investment process?
So it's not just about looking at raw returns, it's about understanding the underlying strategy and how it's performed over time, through both good times and bad.
Exactly. If someone has consistently outperformed across a wide range of market conditions using a well-defined approach, that's a much stronger indicator of skill than simply riding a hot market or getting lucky with a few concentrated bets.
It makes sense, but even then, there's no guarantee, right? Even the most skilled investors can have periods of underperformance or make mistakes.
That's absolutely true. Investing is a complex and ever-changing game. Even the best players have their off-seasons. The key is to focus on what you can control, your own process, your risk management, your emotional discipline.
This is all making me rethink how I approach investing. It's not about trying to be the smartest person in the room or chasing the latest fads. It's about having a sound strategy, sticking to it, and accepting that there will be ups and downs along the way.
That's a great takeaway. It's about being a patient and disciplined investor, not a gambler or a speculator.
All right, we've covered a lot of ground in this deep dive. We've explored the idea of a random walk, the limitations of traditional investing approaches, and the power of our own psychology. But before we wrap up this part of the conversation, I want to circle back to something you said earlier about market efficiency. I think our listener might benefit from a little more clarification on what that actually means.
You're right. That's a crucial concept to understand. Market efficiency essentially refers to the degree to which market prices reflect all available information. In a perfectly efficient market, prices would instantly adjust to any new information, making it impossible to consistently beat the market. By exploiting inefficiencies,
So if the market is truly efficient, all those analysts and experts are just wasting their time trying to find undervalued stocks or predict future price movements.
it's not quite that simple. There are different levels of market efficiency. Some argue that markets are highly efficient, especially in the short term, while others believe that inefficiencies exist, particularly in less liquid or less scrutinized markets.
So there's still room for skilled investors to find those hidden gems, those mispriced assets that the market hasn't fully recognized yet.
That's certainly one perspective. And there are investors and fund managers who have built successful careers by exploiting perceived market inefficiencies.
This is making my head spin a bit. So are markets efficient or not? Is there a definitive answer?
That's the ongoing debate, and it's unlikely to be settled anytime soon. The reality is that markets are complex systems influenced by a multitude of factors, both rational and irrational. There will always be degrees of efficiency and inefficiency, creating opportunities for both skilled and less skilled investors.
So it's not a black and white issue, it's more of a spectrum.
That's a good way to put it. The key takeaway for our listener is that understanding the concept of market efficiency can help you approach investing with a more realistic perspective.
It's about recognizing that there will always be limitations to our ability to predict the future, and that diversification, risk management, and a long-term mindset are essential for success.
Exactly. And it's important to remember that even in a highly efficient market, there's still a role for smart decision-making. It's about choosing investments that align with your goals, managing your portfolio effectively, and staying disciplined through market fluctuations.
So even if we accept the idea of a random walk, that doesn't mean we just throw our hands up and let fate decide our financial future.
Absolutely not. Understanding the randomness can actually be empowering. It frees us from the illusion of control and allows us to focus on the factors we can influence.
It's about playing the game strategically rather than trying to outsmart it.
Well said. And that brings us back to the question we posed earlier. If markets are truly random, does that make our choices any less meaningful?
Yeah, I think we're finally ready to tackle that head on. What do you think? Does embracing the randomness diminish the importance of our decisions? Or does it actually enhance it?
It's a fascinating paradox, isn't it?
Yeah.
You could argue that. Acknowledging the random nature of the market makes our choices even more significant.
Okay, explain that one to me. How does less predictability equal more meaningful choices?
Think about it this way. If we're clinging to the illusion that we can perfectly time the market or pick winning stocks with absolute certainty, we might be tempted to take unnecessary risks or become complacent about our long-term strategy.
Because we think we have more control than we actually do.
Exactly. But when we embrace the reality of randomness, we're forced to confront our own limitations. And that can lead to a more thoughtful, disciplined approach to investing.
It's like that old saying, the only constant is change. We can't control the market's whims, but we can control how we react to them.
You're getting it. Embracing randomness encourages us to focus on what we can influence: our savings rate, our asset allocation, our investment costs. We become more strategic about managing risk, diversifying our portfolios, and sticking to a long-term plan.
So instead of trying to outguess the market, we focus on building a solid foundation that can weather those inevitable storms.
That's a great way to put it. It's about shifting our mindset from speculation to stewardship. We're not just playing a game of chance. We're carefully tending to our financial well-being over the long haul.
This whole conversation has really flipped my perspective on its head. I used to think investing was all about finding that magic formula, that secret sauce to beat the market. But now I'm starting to see it more as a process of continuous learning, adapting, and making informed decisions based on the best available evidence.
That's a much healthier and ultimately more rewarding approach. It's about embracing the uncertainty, recognizing the role of both skill and luck, and committing to a strategy that aligns with your values and goals.
So instead of chasing those fleeting moments of market-beating euphoria, we find satisfaction in making steady, incremental progress towards our financial aspirations.
Exactly. And remember, understanding the concept of a random walk doesn't mean we abandon all analysis or thoughtful decision-making. It simply means we approach investing with a more realistic set of expectations, recognizing that there will always be elements of both predictability and unpredictability at play.
So we're not just blindly throwing darts at a board. We're making informed throws, understanding that the target might move a bit while the darts are in the air.
I like that analogy.
Yeah.
And that's where the real skill comes in our ability to adapt to those changing conditions, manage our risk effectively, and stay committed to our long-term plan.
Well, I have to say, this deep dive has been a real eye-opener. I've learned a lot, and I think our listener has too.
It's been a fascinating conversation, and I hope it's inspired our listener to think differently about their own approach to investing.
To embrace the randomness, yes, but also to recognize the power of informed choices and a disciplined, long-term strategy. So as we wrap up this exploration
Of the random walk.
and its implications, I want to leave our listener with this final thought. If markets truly are unpredictable in the short term, does that make the journey any less worthwhile? Or does it simply add to the adventure, the challenge, and ultimately the satisfaction of achieving our financial goals? We'll leave you to ponder that.